Welcome to Advisor Talk with Frank LaRosa. Brought to you by Elite Consulting Partners, it's the only podcast offering unfiltered guidance and direct advice for all things concerning financial advisors, RIAs, and the practitioners in the wealth management business. Learn more and subscribe today at eliteconsultingpartners.com/podcast. And now, here's your host, Frank LaRosa.
Hey everybody, welcome to Advisor Talk with Frank LaRosa. I'm your host, Frank LaRosa. As always, I appreciate you joining our show today. Today I'm bringing something a little bit different to the show. I have the managing director for CSG Partners, Stephen Berman, on the line, or in video if you're watching us on YouTube. And today we're going to get into what is an ESOP, right? And I know most of you are in financial services if you're listening to us and you're a financial advisor, and I would hope that you know what an ESOP is. But how does an ESOP relate to you if you're thinking about going and building out your own independent practice? If you're leaving a wirehouse and you want to go to another firm and you want to start your own firm and you want to incentivize your employees and do all those great things. And so I've asked Steve Berman to come on the line today. He's an expert in this. He's a co-founder of CSG Partners, like I said, and we're going to get into the weeds here. So Steve, welcome to the show. Thanks for joining.
Pleasure. Nice to be here.
Awesome. So although the majority of my listeners are in financial services, and I would hope that they know what an ESOP is, if they're giving financial advice to investors. One of the things that is happening within financial services industry is obviously the population is getting older, and more advisors are moving and opening up their own shops, right? They're opening up their own RIAs, or they're affiliating with a firm, and they're creating their own company, and they have employees now, and they're in a different position. But then what's happening is private equity is coming in to the business, and they've been coming in because they realize the amount of cash flow, consistent cash flow that a financial advisor's practice kicks off, right? And so they're interested in that. And I'm talking to a lot of advisors about, well, that's a great way for them to monetize their life's work, right? They have a team that, some of them are bigger or smaller, and they go to private equity, they sell their firm, they get a great deal, or maybe they sell half their firm or whatever it is, or they take on cash, and all of a sudden the culture of these firms change because the PEs come in, they want to cut costs, they want to do all these different things, and the culture changes. And what you're really doing, I mean, from what I've seen, the calculations that I've seen is you're basically just getting 7 or 8 years of upfront cash flow, right? And then after that, you're sort of underwater on the deal. And I was talking about this, there's got to be another way to monetize, right? There's synthetic equity, there's all sorts of ideas, but this idea of an ESOP is something I don't think is talked about enough within our space. And so I'm really happy to have you on and really get into this. One, for my listeners. Two, personally, right? As a growing company, I'm close to 60 employees, contractors, right? And I too want to figure out ways, how do I not necessarily monetize my practice today, because I'm not looking to do that, right? But how do I engage my employees better in the organization? How do I get more buy-in from my employees and reward them for the growth of the business, right? And incentivize them to stay and all that good stuff. So can you just start off with, number one, your background, and then number two, let's just get into sort of the high level, what is an ESOP, and then we'll go from there.
Okay, real quick. So my background's also been in financial services my entire career. The first half of my career, I was with directly or indirectly working for Prudential, primarily managing private equity funds. So I've been on the private equity side. I've been on the side of acquiring companies, buying their cash flows, and taking that company forward and letting it grow. After doing that for a long time, for a variety of reasons, an opportunity was created for us to organize and form our own company it was called Corporate Solutions Group, shortened to CSG over the years, which advises exclusively privately held companies. We're an investment banking firm. We raise capital, we do M&A, but our primary driver for the last 18 of the 20 years that we've been in business, actually it's 22 now, has been in doing leveraged ESOP transactions. First of all, the acronym ESOP stands for Employee Stock Ownership Plan. It's not a stock option plan, it's an ownership plan. Basically, the owners of the company will be in a negotiated sale to a trustee, professional trustee that will be engaged, will be selling a portion of their company. It could be all, it's whatever piece they want to sell, in a negotiated sale to the trust in exchange. And what they get back, of course, is consideration. It's cash, could be cash and notes, some combination. And they may retain an interest either directly or, as you mentioned about synthetics, it can be structured. It's highly flexible. It can be structured. Another way to look at it very simply, imagine a 401k plan that has as a single asset the stock of the company, because it's a benefit plan. It's an M&A deal wrapped around a benefit plan. And the beauty of that is, and the real driver of that, and the reason why it works so well, and the reason why it motivates people to do this, are A, the tax attributes, which because of a benefit plan provides enhanced tax deductions at the corporate level, and is properly structured, allows the sellers of the company to defer their capital gain tax forever. You heard me right, forever. So they pay no capital gains tax on the transaction. That's a wonderful attribute. And the company gets additional deductions that it didn't otherwise have. That's really of a non-cash nature. So at the end of the day, Uncle Sam is really paying the side of the equation of a private equity deal that would otherwise be paid for by the PE firm. Because what does a PE firm do? When they buy your company, they typically will leverage it, utilizing the cash flow, and the rest of it will be kicked in equity. Here, it's going to be a leveraged transaction, maybe not to the same magnitude, but maybe to the same. It's a matter of what the owners want to do. And then the rest will come through tax savings, which is kind of like the hidden equity in the deal. And why owners do that, in addition to the tax attributes, is that it allows them, if they so choose, and most do, to stay involved in the company, still run their company, still be in control of the board, and continue on for many years until they decide, what's next, which could either be a second sale to the ESOP, because you've now set up a liquidity platform where over time you can do a second sale, third sale, multiple sales over time to the ESOP. Or if you decide, no mas, it's time to exit stage right and never look back, you can still sell to a third party. It does not prohibit that sort of sale. So that's simply put, without getting into the niggling mechanics of the ESOP itself, kind of the high level aspect of it.
So you're saying that they can do something like this, and if for those of you watching on YouTube, you'll notice that I'm taking meticulous notes here, because this is definitely relevant to my business as well. So you're saying that they can do this, and effectively the employees have equity in the company. So then, if they did decide they wanted to have a monetization event with a PE firm that was going to offer some crazy multiple, then they could really vote on it, or they could the employees would have an additional benefit. Because the other thing that I see is that you have one or two people that own the organization, right, and you have a dozen people or so that help build it, and then they go do a PE deal, and only the small handful of people at the top actually got any real benefit from the deal.
This is different. Okay. When the sale occurs, it implies several things. One, obviously there's been a sale, so there's been a transfer of some ownership into the trust in exchange for consideration that went to the sellers. It sits in that trust and then gets released over time as the leverage of the ESOP rolls off. So it's not all distributed immediately. More importantly, to most owners, the stock isn't distributed physically to the employees. What it is, it's the asset. As I said, it's kind of like the only asset of like a 401k type plan. So the stock is in the plan. Each year there'll be an allocation that's done by benefit specialists, third-party administrators who can do the work for other kinds of plans, typically can do the work here. They figure out each employee is going to get stock put into their account based upon what their W-2 comp is relative to others. Somebody making 200 grand will get twice as many shares in their account each year instead of making 100 grand. But each year they'll be getting shares in their account. Each year there'll be an updated valuation. Each year they'll get a statement that will tell them how many shares are in their account, what the most recent value is, how much of it's been vested, because it has a vesting program, just like any benefit plan. But the important thing here is they're not physically getting the stock. It's kind of a tracking tool. I mean, it's really it's in the trust, but it's a way of having the employees begin to literally see, share when they get their statements, what sort of value buildup there's been. And that value buildup happens as the equity value builds, which builds several ways, right? Pay off the debt, that automatically builds up equity value, as you pay down debt, because, you have less debt in the company, the equity value goes up. That's just a natural progression, all else being equal. If the earnings, go up, the multiples in the industry go up, the valuations will continue to rise. And over time, people who have been with the company for a while and see more and more shares in their account, they're going to realize, wow, I'm building a lot in this retirement account. Now, the one thing to keep note of here is it's not the type of account where an employee can draw off of it and gain liquidity immediately. It's a retirement account.
Borrow against it, right?
Or borrow against it, correct. It's a retirement account. But the value's there. And at some point when they retire, you die, or you become disabled, or even when they leave the company, either willfully or they're fired, whatever the case may be, the value that's been vested in their account will accrue to their benefit. That's their benefit. They may not get it immediately because ERISA has been very specific about the time frame of payouts to people who leave, regardless of the circumstance, different conditions for different circumstances, but they don't get paid out immediately. They'll get paid out over a period of, say, if they die or retire, it could be 3 to 5 years. If they leave the company, it could be a longer payout. But the value is theirs, and ultimately, when they get that value, they can roll it into their own personal tax-deferred account, and still won't pay any taxes on it until they withdraw it for the individuals.
Got it. So, what's the difference between? So, I wrote a couple of things down. You talked about what increases the values, paying off debt, and all that other stuff. Do the employees of I'll say vested and unvested employees that are getting this benefit, are you required as an owner to disclose financial documents to them? Like, do they get to see that stuff, or is it what do you have to do as an owner?
So all you're required as an owner to do is to give them their benefits. It's a benefit plan. So each year they have to get a statement of their benefits, which is no different than any other benefit plan. The financial information remains confidential unless you want to show your employees that information. Now, the trustee and their advisor, because they'll have a financial advisor working with them, because behind the scenes, they've got to assess value. If there's going to be a negotiation on a sale, they've got to be sure that they're not overpaying. They'll pay full value, but they've got to make sure that they've documented an analysis that justifies the value.
This is being negotiated with a third party trustee. An owner can't just say, I want 20 times my revenue, like.
Well, they can want it, but they may not get it.
Right.
Right. It's going to be a negotiated sale. It's going to be an analytical deal. Now, the beauty of it is, as I mentioned before, if properly structured, they pay no taxes on the transaction. So that implies that theoretically they could even concede a little bit on the nominal price, because as the saying goes, it ain't what you get, it's what you keep that matters, right?
So that's good to know. Do they get? Do these employees get? And I guess it's all up for grabs, but do they get like voting rights? Do they have any say and control on the firm and direction of the firm?
No. So the board of the directors, which will be created up front with full input by the shareholders who are remaining on board and selling part of it, the governance of the company remains the same. The trustee, as a fiduciary, does have the ability to each year get updated numbers, because they have to update the valuation. They can't do that blindly. So each year they'll sit down and have a call with the company and understand the prospects and all. If issues come up that need to be voted on, it really follows the rules of what I would call corporate law. If you're Delaware, there's certain things that shareholders vote on and other things they don't. If it's a stock sale, they don't get the right to vote. That the trustee doesn't either on a stock sale. If it's an asset sale, there are certain rights. It's technical, that lawyers will chime in on, but it follows the rule. But individual participants in the plan rarely have any say in the matter. As stock gets put into their account, if there was going to be a sale of something that required a shareholder vote, the trustee would vote all of the shares that have yet to be released, and they would, theoretically put out a vote, put out to the people who have shares in their account that they could vote up to the level of their shares. But it's a very rare occurrence, and that takes a long time to happen. I've never seen a case in my since the beginning, and we've done a lot of deals where that's ever come into play in any meaningful way. So it's really not something to lose any sleep over.
So if you're an owner, and let's say you decide, and again, this is part of one of my questions, you sort of referenced it before, where you can sort of do it a couple times. At the beginning, do you get evaluation, then you determine, I want to sell 20, let's just say it's 20% of the company.
Well, actually, you probably want to do at least 30. That's how you get the tax deferral. And to get individual tax deferral, you got to sell at least 30%, and the company needs to be, if it's not organized as a C Corp, it's got to become a C Corp. And you got to become a corporation too. You got to be a C or an S. It can't be an LLC. But all these steps can be achieved.
You have to operate as an S Corp, or can you be an LLC filing as an S Corp?
No, you have to. It's a stock sale, so you have to have a stock-bearing company. So you got to be either a C or an S corp.
Okay, so that could be a right. Got it. That could be.
Now that seems that you'd say, "Gee, that's a problem." It really isn't. I mean, and what needs to happen, and happens in every instance, is that up front there's going to be an analytical exercise that gets done to reveal for the interested party, what the implications would be of moving into a corporate environment if you're currently, say, an LLC, for example, what that really means, and what it would mean, in fact, if you go to a C Corp to get the full benefit of the tax deferral. To get the tax deferral, you got to be as a C Corp. You say, gee, that can lead to double taxation. That's a factual statement, but it's really the analysis that's going to tell you how much exposure you're going to have on the tax side because of the additional deductions you get by virtue of doing the ESOP, because it creates a new suite of deductions equal to the value of the sale. So, as the saying goes, the devil's in the detail on that. But technically, yes, it has to be a stock-bearing entity.
Got it. So what's the difference between this and, say, just like a synthetic stock plan?
Well, they're different for a lot of reasons. First of all, synthetic stock plans are, they're excellent. Typically, they're targeted at a select few as opposed to the general base of employees. That's usually the objective of these plans, which, by the way, can be done in conjunction with the ESOP. One does not preclude the other. Oftentimes, the ESOP sale, which is done to allow the owners of the business to gain liquidity on their equity, which a synthetic does not do. Okay, synthetic is going to basically empower others to have some sort of upside in the company going forward, right? That's the main objective of that. But for the owner itself, it's not doing.
There's no cash. There's no cash infusion.
There's no cash.
Right.
There's no real benefit other than motivating your employees, which is important, obviously, because you want to continue to build value. But it's not a transaction that's going to help the current owners to gain any sort of liquidity and or even a partial liquidity event.
Yeah. For those of the listeners that don't know, maybe not know what a synthetic stock plan is, it's basically, instead of you selling shares of your company to an employee or giving them actual equity ownership in your LLC or whatever it is, you're going to formation, you're creating a document that grants them shares, synthetic shares. So they have no voting rights. They have no control of the company. But if you were to have a monetization event down the road and you gave somebody 10%, a calculation that's done, you give them 10% of the company and you did a monetization event, they would effectively get 10% of whatever the deal it was that you did. The downside is, I believe, that they don't get to the downside for them. It's good for them because they don't have to pay you anything for it. It's bad for the employee because it's considered ordinary income versus capital.
Exactly. So it's not very tax efficient to either the recipient It's got no real benefit to the owners in terms of if they're trying to accomplish a goal of getting some liquidity out of the transaction. And good or bad, it leaves out a lot of employees who, even if they had small amounts, could still find this to be a very attractive and incentivization program for their benefit. It's a great retention tool too. I mean, clearly people who are in these plans and have been there for a while and see that build up are really going to think twice before they decide to exit twice. No, they're not handcuffed. They could leave it if they invested. That value is going to sit there and they'll get it one day. But if they recognize that their efforts are leading to enhanced value, it's a little hard to walk away from, a future if you see a path that value is going to continue to grow.
So with an ESOP, so getting back to the ESOP plan, can you, on the sort of like, the masses versus the few, can you dictate who the ESOP plan is offered to?
Not really. ERISA it tries to make this egalitarian. So really the case is the following. You can set up certain plan guidelines as to how many hours a year you need to work to be eligible to be in the plan. So it can be more embracing or less embracing, but minimally it's going to include people who work, 1,000 hours. It could be down to the people who work only 1 hour a year to be eligible and be in the plan. So you can do a little bit of self-selecting. If you have part-time people, you can, by deciding on how many hours you need to work, it could keep them, out of the plan. But in most cases, most owners are happy to have everybody included because it also expands the size of the payroll that's part of the calculation of your annual additional deduction at the corporate level. So the bigger that payroll, the more you can, quote, deduct each year in addition to your current deductions. It reduces the tax exposure at the corporate level even more significantly each year. So it's a trade-off. Once again, it's an analytical exercise. But that's really the way it works. Now, in addition, as I mentioned, though, you in tandem to that, though, you can have incentive plans for select employees, key people who you absolutely want to keep around, who you recognize through the analysis will do okay or really well in the ESOP, but that's still not enough, that they really deserve more. So you can create, kind of a shadow equity plan. You can do stock appreciation rights. You can do warrants. There's a variety of other tools that can be done in tandem outside of the ESOP.
Got it. So what are some of from the owner's perspective, what are some of the, maybe this is a loaded question, I don't know. What are some of the disadvantages from an owner's perspective on, going into an ESOP plan or creating an ESOP plan?
Well, it's complicated, but that's why folks like us exist, right? We're there to help, help the owners think it through, structure it, help them get the financing, help them get them done, all those things. And it's going to be around for years and has to be administered, but it's not really a bad thing. To me, the people who in particular should not think about ESOPs seriously are those who own businesses where, as a result of the transaction, they're going to exit stage right and there's nobody to run the business, because it almost begs the question, what would a trustee be buying into, right? What would any buyer be buying into if you have a company that's headless? PE it's a different kind of transaction. For folks who don't want to be bothered and want to really wash your hands of things, that really might be, it may not be as attractive economically as an ESOP, honestly, because the ESOP tax benefits could overwhelm even an attractive PE deal, but it could relieve the owners of any responsibility going forward if that's what they want.
Yeah, their employees aren't going to be happy because they sold out to a PE firm that's going to, pinch every penny, but they don't care because they're leaving.
Right, but if that's the objective, that might be the right answer. But I would argue that even in those cases, they should always look at the ESOP alternative before they make that decision, unless they're so committed to the notion of I'm exiting and I don't care, make it somebody else's problem going forward. But if they're willing to stay involved, even for 3 to 5 years going forward, and they have a master plan where there'll be somebody to take over the company, they should look at it. What are the downsides are there to an ESOP? Well, it's going to include all the employees. And frankly, some owners are always going to be concerned about the concept that they have in their mind that the employees are owning some of their company. Sometimes it's a mindset because it's not really a reality. The reality is it's in a trust. As I mentioned before, it's like a 401k plan with a single asset will be the stock of the company. It's a benefit plan. Now, don't get me wrong. It doesn't mean that the employees may not, even though that's a fact, that's technical, that's accurate, that's real. Some employees, really take ownership to heart, that's not just building up the value, but they say, yeah, I'm a part owner. I want to stay in the business, even though they don't have one. So can it create a little bit?
You have
of
to
noise?
sort of delicately handle that answer, like, not really.
Not really. The answer is look, but here's the other side of that coin, which mitigates, any resentment they may have on that point. They're getting this benefit for free. It is costing them zero. They do not pay into it a dime. So it's a free benefit. I've been part of meetings, education meetings, because education is key post-closing. You want the employees to know about this. Hopefully you do. I mean, most cultures you want to instill, we're all rowing in the same direction. And if we build value, we all benefit, right? Different amounts to different people, but we all benefit by it. But I've had people raise their hand at a meeting and say, can I opt out of this? And, I try to keep them smiling, but I have a little smirk on my face. I say back to them, it's not costing you anything. Why would you want to? One, I don't think you can, because I think the rules are everybody's included. But why would you want to opt out of it?
Right.
Yeah.
The company's giving you something for free. So this isn't in lieu of like a quarterly bonus or anything like that. This is on top of. Yeah.
So this is a strategic decision on the part of the owners of how they want to motivate, incent, and compensate their people. It's an extra benefit. Some owners say, this benefit's great. I'm going to cannibalize some other benefit we have, 401k plan that we participate in, whatever it may be. Others say, you know what? We're going to keep that plan in place as well. We're getting a lot of benefit out of this ESOP plan. We're going to get, tax-free liquidity out of this. We're going to have better, all these new deductions at the corporate level. I'm good. I'm happy to leave everything in place. We usually advise, we can do is advise, we can't make the decisions. We usually advise owners not to cannibalize all the benefits, because it's good to have, even though we're not really benefit people, we're corporate finance people, but it's good to have some what I would call plan diversification, because this plan is the sole asset is going to be the stock of the company. And, there can be some unfortunate events or times that are bigger than all of us, and best laid plans go afoul, and their value may not always go up. It could go sideways. It could go down. Hell, it could go to zero. There's no guarantees at all as to where it's going. But so if they have other plans that are invested differently and you can participate, they can put cash into.
We have a 401k, so we provide a 401k, and we have a safe harbor plan. So we contribute 3% to our employees' 401k, no matter what, even if they don't contribute. And sometimes we get the same question. Well, do I have to participate to get it? We're like, no, you're going to get it anyway.
Right. Exactly. So, but you can make the decision. You can say, look, we're giving this benefit, and you can even, say if the company does well, it's going to be, multiples of your salary, which that's not BS. That's true. It's usually, if the value builds inside their account, ultimately they're going to see over time, relative to what they make in comp, a very astoundingly high number, that's going to build over time. But that doesn't mean that you should, it's your choice. The owners of the company are in control of this. They can decide, we're going to leave those benefits. You may decide that you're going to cut your match from 3% to, I'm making it up, 1.5%, 1%, or nothing. But that's your choice. You may say, I'm going to keep it all now, and in the future you may change it. But you can always point to the fact that, look, we left it in place, make sure everything settles, but now you've got this benefit, it's growing. We're not going to match it anymore.
So are you making the contributions or the grants or awards, whatever they're called, award, I guess. Is it done like quarterly, annually? How often do they do that?
Yeah, so the benefit plan, the ESOP is the value is reset, and this is done once a year. Okay, so you get the year end, then the trustee has to do its refresh meeting with the company so they can update their projections. So to take this back for a second, let's take 3 steps back. When you talk about free cash flow, and that's what PE is paying a multiple of, trustees doing the same thing. They need to better understand, what the prospects of the company, and the company isn't static; it's dynamic. So each year they need to get a refresh because now they got to shift everything a year to assess value. So each year they're going to, kind of do that refresher, and once that number gets locked in, then and agreed to, because then after the trustee does their work, and the valuation firm for the trustee comes up with a value. They meet with the board, of which typically the owners who are selling are part of. They talk about it, make sure that nobody had a swing and a miss on.
How is the board created? Who is on the board?
Up front, it's decided and it's agreed to, and it's decided by the current owner. So, let's use you as an example.
What if it's me? Like, I'm the owner. I'm 100% owner of the company.
Right.
So,
but going forward, ESOP will have some. If you'd be, they'd say we'd like you to get at least one more board member, maybe even 2. You can pick them. But we want that in place. Within a year of closing. It won't even have to be a closing. It's a good faith thing. But as a trustee, they want to make sure that there's at least an appearance of good corporate governance. And it's usually more than just an appearance. It's just the right thing to do, going forward.
And then the trustee is on the board.
No, the trustee is not on the board. Trustee is never on the board. You'll pick the board, they'll approve it. They may tell you, look, you want to find somebody from the outside. If you can't find someone, we can give you some ideas, but feel free to go out and, identify people that you think would be good additions. Look, if you do this, meaningfully, you're typically going to try to find people or know people who will be additive to the corporate brain trust,
So these aren't necessarily going to be people that are already at the firm, like your C-suite.
It can be or not be. That's they're going to be looking to you. They have no idea how to run your company, nor do they want to run your company, nor will they ever run your company. So they're going to be relying on you to say, tell us what you think makes sense here.
Well, they're really just administrators.
Fiduciary,
plan.
Right.
They're not really kind of come in and tell you what you should be doing, and
not at all.
You can't do that, or you can't invest in that, or you can't open up another office, or you can't,
not at all.
Right.
Not at all. I mean, what as a fiduciary, all they're going to be looking out for is to making sure that things are done, responsibly, I guess. If for example, they were provided with a forecast which built into it, known to everybody, that you were going to make $400,000 a year, because you're going to lock in even though you may make a lot more, you're going to take a lower comp, because then you could model in extra EBITDA going forward to build up the value on the sale. It's a very tax smart thing to do if you want to do it. And then you decide, and you have a bonus plan too. But notwithstanding all that, you say, even with all that, maybe with a bonus that was built into the plan, it's 600. I'm going to pay myself $2 million. They would say, hold on here. We paid you based upon what you promised you were going to do of being paid less, but we gave you value for, the rest of it we built back into EBITDA. Not so fast.
Right. You're crushing the EBITDA. Right.
Right. But we paid you for some of that anyway, because if your projections show that you're killing it because you showed it, and we paid you for that, and it was based on a certain comp level, and you had a bonus plan anyway for a period of time. Any bonus plan, anything that's set up is usually just a 5-year plan, and 5 years of it still there. Everything could be reviewed and renegotiated anyway. So
right. So getting back to the component that I'm just checking on the time, getting back to when you talk about it's got to be a minimum of 30%. So let's assume someone's willing to do that. Are you doling out the entire 30% all at once?
No. when the 30% is sold and the ESOP now has that 30% block of stock, it is sitting in the trust, but it hasn't been distributed yet. Each year, as contributions can be made by the company, tax-deductible contributions can be made by the company to the ESOP. It's formulaic. It's up to 25% of the eligible payroll, but they have to look at other plans you have. It's a technical calculation that third-party administrators are expert at figuring out. Each year they will look at how much could be contributed, and that will release a certain amount of shares each year, okay, based upon the value of that relative to the value on the sale, okay, that 25% of payroll. Additionally, the company can also pay dividends to the ESOP each year if it wants to, which will release more shares, but create more of a deduction because it's the only time that a dividend is tax deductible, is when it's a dividend paid by a company to its ESOP so that the ESOP can pay back its debt. When you do that, and it's all discretionary, okay, but when you do that, it creates a second deduction at the corporate level, reducing the tax exposure that you'd have in a C Corp even lower, or eliminating it completely, oftentimes. Okay, it'll go into the trust, then will release more shares in that year. And over time, the full value of the sale, whatever that dollar value, will fully release all the shares. Could take anywhere from 4 to 10 years to happen before all the shares are released.
Got it. Now, you're saying also you can elect to pay a dividend if an employee is vested. Do they get a dividend? Can you pay them the dividend?
It's not paid to them directly. This is all done through the trust account. But their account then, on the part of the dividend that may stay in the trust, would become. So ultimately, everybody's in more mature ESOPs, like you see, are two things in an individual account: a stock account from shares that have been allocated every year, and a cash account that's side by side with it. This is all inside the ESOP. There's a cash account as well for cash that may have come in and stayed there for like dividend payments or whatever on the shares that stayed there. So ultimately, when they leave, they would get the combination of the values of the stock will grow. Eventually, you get enough cash in there that the trustee may begin to have that professionally invested, yes, safely, but get a return on that money for.
So they are getting it. It's just they're not getting it.
They physically never see any of this. It's all in
an account. Yeah.
Yes, that's correct.
Got it. So, in the interest of time, because we can keep going down this road, how does an owner, I guess an employer, but an owner, so where do they incur fees to run this plan? Who are they paying for what?
Right. So I'd say, depending upon the size of the deal and the number of employees you have, a third party administration fees are done usually on a per capita basis, how many folks you have and what they charge for that. Then you've got I'm answering your question, but then there's also the trustee and the one-time valuation every year. If you have more than 100 participants, you need to get a plan audit each year. That's just an ERISA rule. The cost of maintaining a plan will be anywhere, for all these parties, from $35 to $100,000 a year. I know it's a big range, but it depends upon the size of the transaction, how many employees there are. I'd say a good average would be about $50,000 a year, which is, of course, tax deductible at the corporate level. It's an expense, but it's an expense.
What is a typical size company that does this, whether it's revenue size or employee size?
Yeah, so the way I like to look at it is several-fold. I mean, first of all, it's a stock sale, so you got to look about transaction size, and I'd say a transaction size of at least $5 to $8 million, which could be for 30% or could be for 100%. So that changes the size of the equity value of the company dramatically. If it's $5 million of 100%, the company's equity value is $5 million. If it's $5 million of 30%, the company's value is like $16.5 million, right? So it could be any of those things. which implies if you go backwards about the multiples of, say anywhere from 5.5 to 10 times, depending upon the industry and the growth curve, you have companies that typically have EBITDAs of adjusted EBITDAs when you do some add backs of appropriate add backs of 2.5 to 3 million minimally. And obviously anything above that is fine. Yeah, it's totally cool. And the number of employees, you want to have at least 10 to 15. There are certain concentration rules where that smaller number of 10 to 15 employees has to be analyzed to make sure that you're compliant. But after that, it's not an issue at all. But for most companies that we deal with, which have EBITDAs of say, 3 to 100 million, most of them are like 7 to 25 million. That's just kind of a lower middle market a sweet spot for us. They typically have between 25 and 100 employees. It can be qualified very easily. A couple of quick questions to an interested party can very quickly make it apparent as to whether there's a pony in there somewhere. Whether there's a possibility of doing a deal.
And where do you fit in? So where does CSG Partners fit into this whole thing?
Sure. So we're initially we're the folks who will do kind of what we call the early feasibility study, and there's a fee for that will reveal for the owners whether or not the ESOP really makes sense, what our estimate of value is, even though we're not the official party, because the trustees is the buyer. They've got to validate that, it's what they're willing to pay. But we've done so many deals that we can do a decent job of, simulating their analytical work. We're not always right, but it's a pretty tight range.
Yeah, 2 feet of the hole, as I say.
Exactly. You make most of those parts, right? Most of them, not every single one, but most of them. And then you've got the feasibility study that will tell you about the value. Then they'll tell you, in our opinion, how much external debt could be raised for the transaction. We'll show you a range on that. Doesn't mean you decide to take all that debt, because there are plenty of owners of businesses who we say we know through our relationships with literally 100 plus banks nationwide who understand ESOPs, because we do a lot of transactions a year, that we believe we could raise for you folks X amount. And they say, well, we've never had that much third-party debt before. We don't even want to take that much. We'll take a little bit less. We'll get that cash tax-free. We'll take the rest in seller notes that will get paid off over time. And we do that assessment as well. And then we do a very granular 5-year cash flow at the corporate level and for the individual sellers as well, to show them what a transaction or transactions at different magnitudes of sale, what that would look like each year in terms of after-tax cash flow to them and to the company every single year. And you see all this stuff. And it gives you a lot to work with to decide whether you want to go forward or not. Those kind of studies cost usually, $7,500 to $15,000, most of it like $7,500 to $10,000. It's about a 50-page, not that volume matters, but in this case, there's no filler. It's all pith. It's all analytical. So you learn a lot about your company, at least from a third-party view, value and financeability and cash flow possibilities and tax implications, all that. Then if you want to go forward, then there's then we hopefully, David, there's no guarantee, they're not obliged to hire us to execute a transaction after that, but hopefully they have found our work useful enough and our advice to be valuable enough that they do. And I'd say in 99.9, there's always one exception. I can't think of it, but sure there is one. But in nearly every instance, they'll hire us, retain us. We get small retainers for different deliverables along the way, in terms of, putting together a SIM, because it's an M&A transaction. As I said at the beginning, M&A transaction wrapped around a benefit plan. We got to put a whole M&A book together. Looks just like an M&A book, but we're not sending it to PE firms. We're sending it only to the trustee and a bank for financing, and then we close the deal.
Okay, so I appreciate your time today. So where does someone go if they're interested in having this conversation with you and exploring, in our industry as these independent advisor practices grow and they become enterprises, right? Where they fit into this category, just multiple millions of dollars of top line revenue and very strong EBITDA and and 50, 100, 150 employees, 200 employees. I can count a number of them that I know of off the top of my head. Where do they go other than, I guess, csgpartners.com is your website?
It's a great website with a lot of, as you know, you've been there, a lot of educational videos and other, useful information. And, my cohort, all of my colleagues' contact information is right there, unless you want to provide it otherwise. It's up to you.
Got it. Yeah. And, so if they want to just give you a buzz, what number can they call?
If they wanted to get in touch with me, they could call the company's general number. They could send me an email at SBERMAN, Berman at CSGPartners.com. And we could start a dialogue there.
Awesome. All right, Steve, that was a lot to take in.
I hope I answered your questions.
It was great. No, it was super, especially for someone that's sort of going through this whole process as we speak. It was very, very timely. And again, it is something that I think, when I work with advisors and ask them what do they want to be when they grow up, and we talk about they want to build an enterprise and they want to have all this valuation and they think about those things. This is the kind of stuff, and it's like you said, the deck, the package that you put together. Sometimes when you go through a process like this, you start learning about what you're not doing right in order to get the best valuation out of your company. So I think that could be a useful exercise as well. But I appreciate your time. This has been tremendous. And I look forward to hearing, what kind of clients you get from the call. And
absolutely.
And I appreciate the education for sure. Thank you.
Make a pleasure. Thank you for the time.
Thanks a lot. Bye-bye.
Take care, everyone. Bye-bye.
Thanks for listening to Advisor Talk with Frank LaRosa. If you're looking for more advice or solutions on any topics in the financial services industry, or you just want to subscribe to our podcast, head on over to eliteconsultingpartners.com/podcasts.